Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
But when you have China with a massive amount of goods they have to get out that are subsidizing their exporters more and more, and I hate to use the word dumping, I don't want to use that term, but pushing more and more and trying to push this what should be domestic adjustment for China onto their trade partners, you're seeing more and more trade friction grow in the world and more trade barriers going up because it seems to be the only way the West can protect themselves because China, and again it goes back part and parcel to the currency policy. They don't allow their goods prices to rise because it's fixed or pegged to a dollar that was funding the global economy and fell in value. So those trade frictions are there. And not only that, you have this what's called because the money is locked inside the system. If you look at that second to last box there on the bottom, and as I said, because of the peg of the currency, because of the capital controls, money can't get out of China. So it builds and builds. Hot money builds up in China. So you not only have this massive stimulus from China itself creating this liquidity, you have money from the outside moving in to want to get into this growth. So you have more and more liquidity inside China that can't get out. It's kind of like the Roach Motel, we've referred to it, of countries in terms of liquidity. Money goes in but can't get out, especially the domestic stuff, and it has to go somewhere, and it's gone into a massive overproduction of infrastructure, massive real estate build, and a lot of it into their stock market. So there's the problem here, and we're finally starting to see, and it's lagged, and today, in fact, was the first time we started to see the announcement that it's creating an inflationary problem in China, and that really is the worst scenario for Chinese policymakers is inflation. I mean, it's the reason they've had riots in the past, even during more normalized business cycles. And here, where global demand isn't there, and they have inflation in China, it's a recipe for social unrest. And this is why there's so much concern that China is really going to start clamping down on credit, because they can't have inflation run away, because the social unrest will tend to really come off the scales there, and that's the last thing Chinese policymakers want. So this idea of this money locked in the system starting to finally feed through into inflationary numbers could create a counter reaction from the Chinese of overdoing it and putting the brakes on too hard here. And as we said, since they're the driver of demand now in the world, that's a very, very precarious situation. And it all, again, comes back to their capital controls, and they're wanting to keep their currency under wraps in terms of pegs. So this chart, just wanted to show you in terms of overcapacity. A lot of people don't quite understand how much China has invested in infrastructure relative to other economic miracles in the world. This chart just shows China is the red line, really just off the charts. We've never seen this historically, and this is gross fixed capital formation as a percentage of GDP, up over 50%. This is even higher since then, and it just goes to show how they've neglected the domestic side of their business in order to build infrastructure to build global share around the world for exports, and that's the rub. If the U.S. doesn't respond quickly, they're still sitting on a lot of excess capacity, which should ultimately roll into lower growth numbers. So there's the other risk. Even if there isn't a credit crisis, if the Western countries don't rebound, and we're sure not seeing any rebound in Europe, we're going to see massive austerity, it looks like, there to try and save the euro. That's a demand factor coming out of the world. If the U.S. jobs market does not rebound, the demand is not returning there, and that's where this overcapacity problem in China really just starts to just weigh on them, and that weighing on them, in effect, is going to do two things. Number one, it means they're going to have to mark down their growth projections, and number two, we're going to see a continued increase in trade frictions. So that's part of the problem with what's going on at the moment. And again, it stems to the fact that they don't have a a valve to release this pressure because their currency is fixed and because they have capital controls. If they didn't have that, this problem would not be as serious because they could let some of that money flow out, and that's what a floating currency helps you do. Needless to say, floating currency is not a panacea for anybody, but it does help in a situation like this and provides that pressure valve for them, which, by the way, is another reason why those countries in Europe, again, you see a similar tie in here. The countries in Europe, the pig countries, the fiscally problems that are fiscal basket cases, they're hamstrung by that euro. They don't have their own local currency that could adjust downward to take some of that pressure off. They're in that euro straitjacket that really is a currency for Germany first and for them very much last. And they don't have the pressure valve, so they're having to take that adjustment domestically. So there's some parallels here. The point here on the right is just to show some of these numbers getting out of hand, and as more and more credit comes into the system, which we see in any cycle, the more and more credit you pump in, the more and more credit you need, because it's less and less stimulative. Now it takes $7 of new credit to create $1 of GDP versus $1.50 of new credit to create $1 of GDP in China. Not sure how these numbers were generated, to tell you the truth, but it's common. It's not just a Chinese problem. And that's a problem when you get over leverage. When you over leverage and put more and more money into the system needs that much more to provide the same level of stimulus, and we're just not sure how much more China can pump in here given the pressures that are growing, and especially with the inflation side rolling on. Credit to GDP approaching 140% in 2009 in China, making the point that that was right before we had the same level in the U.S. before the credit crunch popped and the markets went down, and it was very similar to what went on in Japan in 1991, and we saw their incredible bubble poppage really throughout Japan, and their real estate just go right down the tank at these numbers. So that just shows that. How do they relieve this situation? The China model dynamic is the ability for them to become less dependent on the U.S. consumer, again, is just to build their own consumer market, number one. Number two is to build a deeper bond market, in effect, for local funding, which goes to all emerging markets that don't have to be dependent on an outside liquidity flow. China isn't to the same degree of any emerging market because of their ability to create such a massive current account surplus, but a lot of the emerging markets are all dependent on the West in terms of bankers to fund. This whole idea of having more stabilized local bond market in China will go hand in hand to the process of creating a more free-floating currency, and again, the idea of stabilization and less volatility and less risk. So if they were to, the upshot is that if they do create a floating currency, which I think they're still a long way off, but even allow their currency to reevaluate upward, you're generally going to see less of a demand. Ultimately, it comes back to a floating currency. If they float their currency, they really don't have the need to hold U.S. paper to the same degree, and that's a big dynamic change in terms of the U.S.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.